I mean, this is the seed of a new asset class that is on a vector that is unlike anything else we've ever seen, separating state from money. Never happened before. And the need is going hyperbolic up because states are collapsing. Look at the chaos in America and all over the world. Money printing, parabolic. I mean, look at the money printing that's going on. 30% of all money in America printing, I think, in the last 4 years or something like that. And just an amazing amount of paper out there. And the ability to transact online is instantaneous. Anybody with a telephone can buy Bitcoin. Money managers have no problem getting huge amounts of cheap money. They can buy Bitcoin. Well, I think the state, you see, there's a game theory layer baked into the Bitcoin protocol. And we want the states to try to get involved. And we want the sovereign wealth funds. And we want the hedge funds. And we want the Michael Saylors. And we want the private corporations. And we want the balance sheets. And we want Elon Musk. And we want Jeff Bezos. Because the more people come into Bitcoin, the hash rate goes up, the security goes up, and the price goes up. So we want everybody in the world, every government, every sovereign wealth fund, every money manager, every household to buy Bitcoin and to enjoy the price appreciation going forward. You do have now that transitionary period that will come from Bitcoin as a store of value, where it is now, to becoming a medium of exchange. And that's happening quite rapidly. And I think it'll start to push aside other payment rails in the next couple of years to unit of account. So we are heading to a world that things are priced in Bitcoin. And so any amount of Bitcoin will be needed if you want to participate in the global economy. So Michael Saylor, he first looked at Bitcoin in 2013, and he was a skeptic. Then what Stacy's talking about there, the block size wars of 2017, convinced him of the robustness of this technology and the invincibility of this technology. And then he did the deep dive, and he is a rocket scientist and runs a technology company. So, he knows how to do his due diligence. And after a couple of years, he emerged as this huge buyer on MicroStrategy's balance sheet. And his use case is that it's a reserve that, unlike the dollar, is not losing 20% due to inflation every year. And so that's what drove him to put it on his balance sheet. And at the time, my thought was that this is remarkable because everybody else in corporate America was looking at that money printing from the Fed and saying, hey, why don't we use that cheap money to buy back our own stock?
Right.
And we've seen this all over corporate America, right? From Apple Computer, the biggest of the companies, all the way down. Executives use that cheap money from the Fed. They buy back their own stock. Their stock options or executive stock options go up by thousands of percentage points, and they're making lots and lots of money. So Michael Saylor could have done that. But Michael Saylor is saying, you know what? I'm going to go against the Fed. I'm going to attack the Fed. I'm going to go against the Fed, and I'm going to borrow that cheap money. And he did a subsequent offering where he did, in fact, float. And he's saying, look, I'm going to take that cheap money, and I'm going to buy Bitcoin. It's very similar to what we saw with George Soros in 1992 in the speculative attack against the Bank of England, where he realized that there was a total mispricing as Bank of England and the euro, the exchange rate mechanism, was such that, and Stan Druckenmiller was working for him at the time, they could attack the Bank of England essentially, and they made $1 billion in a week, I believe, if memory serves, by exploiting this enormous gap in the marketplace. So Saylor is saying, wait a minute, these rates at under 1% are artificial. They're there only for one purpose, to bail out the insolvent banking industry. I'm going to take that money and I'm going to actually attack the system by buying Bitcoin. And he's already made over $1.5 billion doing this. So any other corporate CEO in America has got to look at this, and many have now. You've got at least 20 have followed suit. And then Paul Tudor Jones made it safe for the hedge fund industry. Now you've got all kinds of hedge funds involved.
Right.
And you've got Mass Mutual is an insurance company. They're buying it now. So now it's safe for the insurance industry to buy it. And you already have individuals buying it. And you have high net worth individuals buying it. And so we still have the sovereign wealth funds to get involved. And the state treasuries, the central banks at some point will get involved if they're not already involved. When it was at $1 and then trading at $50, you're like, wow, it's a 50x return. That chart looks pretty parabolic. Same thing at $500 and $1,000 and $10,000. And now we're up around, pushing high 30,000s, 40,000s. But I think what people need to understand about Bitcoin is that it is the birth of an entirely new asset class, and it's on its own vector, and it doesn't correlate with anything, and it's disrupting the entire global money system and disrupting gold. And gold, as we know, is in the $10 trillion market cap level, and Bitcoin should trade at an even market capitalization to gold. So we're talking 400,000 plus per coin. And that's still a huge return from the current high 30,000s to 40,000. That's number one. Number two, there's just not a lot of supply. The Bitcoins on the supply side is very meager. And the protocol is ingeniously designed so that every 4 years, the output or the supply is cut in half. And that, of course, gets people's attention because that supply is shrinking. Unlike the gold market, where the supply is, call it 2.5–3% a year. And if the gold price were to get to $5,000 an ounce, that the supply would go a lot higher because suddenly technology would improve, people would do more exploration, they would find more deposits. And just like we saw in the oil industry, remember the idea of peak oil? And oil was at $147 a barrel. Oh my gosh, well then here's fracking. The technology closed the gap. And suddenly there was a supply glut of oil, and the price got very, very weak. And the same thing can happen in the gold market. Whereas that's impossible with Bitcoin. It's algorithmically deterministic at 21 million coins. That's it. The supply on a daily basis, we're currently at 900 coins a day, is constantly shrinking every 4 years as per the halving. And that gets, so the supply side of the equation is getting smaller and smaller, and the demand side is getting stronger and stronger.